Well, greetings and welcome to the April 2024 Investment Strategy Brief. I want to continue the discussion, which is this sort of tension between caution and optimism, really around, on the optimistic side, AI, and whether that can counter a potential slowdown in the economy. So let's jump in. Now, as it relates to artificial intelligence, as we've discussed before, this is really off the foundation. Our work is off the foundation of the things that we do around long-term themes. We basically identified a number of long-term themes, and the team is kind of regularly updating the work on this. And in some ways, as I've said before, the idea of artificial intelligence was kind of anchored in the fourth industrial revolution, the idea that technology is going to change our world. But the reality is it really is sort of propagating across these different areas and influencing, in some ways, everyday life. And we're really at the very early stages of that. So in any event, artificial intelligence as a result is sort of the theme of 2024 and what's driving a lot of optimism in the environment. Now, we've published a lot about sort of a refresher on what artificial intelligence is, what generative AI is, the impact on the economy. We're going to talk a little bit about that, and almost then a framework for how to invest. And so lots of good content available on that. But let's get into a couple of the concepts in a little bit more depth. So one is the idea of data. Data is the information that AI learns on. And, we've talked before about the idea of 2.5 billion gigabytes of data being created every single day. But here's some examples of what that means. 1.3 billion photographs being shared on Instagram. 22.3 million packages delivered by UPS. So think about it in terms of studying where things go. 8.5 billion searches on Google. A billion hours of YouTube content streamed, 300 billion emails. This is all data. And those numbers give you a sense for it in terms of the volume of information. And that's the information that AI is learning on, right? It's all about, in some ways, how to get access to that data and then be able to process it in the context of the AI learning models, and then how that ultimately is applied back in terms of the AI problems being solved. Now, lots of work has been done by a variety of firms on sort of the impact of artificial intelligence, but one study is interesting and shows that essentially think of it as the economic lift. So an aggregate that global GDP is estimated to be 14% higher in 2030 attributable to artificial intelligence, so $15.7 trillion. And you can see that this breaks down between the idea of improved productivity, so automation, things like that, accounting for about 6.6 billion of that increase. But then product enhancements, so things like AI-powered diagnostics and the sort of predictions in consumer behavior, things that will sort of make the process and sort of products that we have ultimately better. And that's $9.1 trillion. And so just think of it as a big lift in the economy. That's what the optimism is all about. And in fact, while it's easy to look out to 2030, for example, the reality is it's really happening today. So we've got things like, the idea of being able to do healthcare research, medical research. And so this idea of a shape of a protein, for example, seems interesting and kind of curious. But the punchline is to go back in time and look at how that was done. It would take years and years and years of research and millions and millions and millions of dollars. But there are AI tools now that essentially can do it almost instantly and at very, very small costs, so certainly compared to past practices. And the reason that's important is really around drug research, right? And so the idea that these kinds of tools, and again, this is early glimpses of this, is sort of a signal of the potential for the future. Another one is the idea with farmers, just to pick another one here, in terms of agriculture, being able to instantly almost scan over 2,000 square feet of farmland to evaluate exactly how it needs to be cared for. So imagine that, herbicide sprays only attacking the weeds, and so that saves money on the spray, but it also improves the crops a bit, the quality of crops, right? And so the idea of all of that kind of sort of propagating out into our economy, and the idea that across various sectors, that is actually happening now, and yet it's still pretty early days. So that's the optimism, right? And so let's now shift to the headwinds, the issues, the things that we're wrestling with. And the one that we've talked a lot about is fiscal transition. The idea that we have a higher interest rate environment, we have a buildup of debt across the economy. We're going to look a lot of data on all this. And essentially what that means is that the economy, consumers, businesses, and government, we all have to figure out how to deal with higher cost of debt at these higher debt levels. And so we're going to go through this transition where we're going to see some pockets of friction and pockets of trouble, and then get through it. And again, we always end up thinking optimistically and get through it in a sort of strong and positive way. But we've got to go through that fiscal transition. And the federal government's a really good example. You know, when we look at the budget and how the budget is not balanced, basically we're operating at a big deficit. And as it relates to that buildup of debt and the increasing cost of servicing that debt, you know, essentially forecasts show that we're really, just in terms of that pattern of operating at a deficit, sort of projected just to keep building on the trouble. Now, one of the things that we did was to pull into this, like take a look at specifically this tax package that was done under the Trump administration. Basically, if that gets sort of renewed or not, it's just going to change things. But I think the takeaway from this is just to say, hey, it's not by a lot, right, compared to overall what's going on. Basically, this deficit level is much more significant and comparatively to the fine-tuning of a tax package here or a subtle change there. So, you know, as we've talked about before, it almost is going to require this sort of self-reflection on how the government operates, and then ultimately looking for ways to close that gap in terms of the deficit, in our opinion. Now, another headwind is really around the consumer, or potential headwind. And, you know, the bottom line is, as we look at how the consumer feels and thinks about things, you know, basically their sort of general view has been, you know, kind of in the neighborhood of the average when we look at over the long term. But when they look forward, basically expectations, there are worries kind of embedded in the consumer mindset almost. And yet spending continues. We had just had a retail sales number that outpaced consensus. And so the spending continues, but people are a little bit worried looking forward. And that can be anchored a little bit in sort of the cracks that we're seeing as it relates to debt. So basically, delinquencies are up a bit. And as I've said, the current level isn't of great concern, but the slope, if that sort of pace of increase continues, that's of concern, right? That's basically the consumer section of the economy dealing with higher rates and not being able across the board, some trouble basically for some borrowers in terms of servicing their debt. So we have sort of the consumer headwind, and then a third that I'll mention, unfortunately, is the wars that we have in the Middle East and Ukraine. And so, for example, we track geopolitical risks. We call it our dashboard, and we're monitoring all kinds of different things and evaluating all kinds of different things. But Middle East conflict is one, and it's come into focus again because recall when Hamas first invaded Israel and came in, and we knew there was going to be a reaction. We evaluated and kind of painted a variety of scenarios really around escalation. And we talked a bit about the idea that substantive and ongoing engagement between Iran and Israel, we viewed as a low probability event. Now, we've actually had essentially attacks going back and forth, but so far limited, with lots and lots of sort of world powers messaging to say, hey, let's keep this calm, right? And so it's very serious. It certainly, as it relates to kind of what's going on in the world, has had an impact on things. We talked about back then the idea that this would spook the oil markets, for example, and that would be a foundation for fueling inflation. And so that's kind of played out a little bit. But again, I think the main message I'd leave you with is we don't think this is necessarily a sustained and active set of engagements, right? That there was some attacks back and forth, but so far it hasn't escalated beyond that. In any event, let's with that as a backdrop, so the optimism of artificial intelligence, some headwinds, let's now turn to some of the macro environment and information that we're seeing that's related to that. And so first, it's inflation and the Fed. And the punchline here, as you can see on this chart on the left, is that inflation, both consumer and to some degree producer price index inflation, has sort of reemerged a bit. Certainly not back to the levels that we saw a while ago. But the punchline is that inflation hasn't cooled consistently down around the Fed's 2% target. And what that's doing is influencing the view on Fed funds rate. When will the Fed cut rates, and sort of when and how much? And that's important because the market rates, the 10-year Treasury, for example, but that's an anchor for things like credit card charges or mortgages. All of those, now all of a sudden the view is, hey, things are going to be a little bit higher. The 10-year Treasury's moved up a little bit. And again, that's driven in part by an increase in energy prices. And on this chart, basically, I just draw your attention to the top line. That's basically oil. So oil's up a lot. This is just year to date. And so think of it as that obviously is the energy, the thing that lubricates our economy in a way. And so the fact that oil prices are up is a problem. Those tensions really relate a lot to what's going on in the Middle East. And so that's something that we're keeping an eye on. So that's the backdrop when it comes to inflation. And then when we turn to the Fed in a more focused way, they're really having to strike a balance. They keep talking about the idea that inflation is going to come down, but it's bumpy, give us a reason to think it's okay for inflation to pop up a little bit. But the Fed speak. When we hear officials giving speeches, it is a lot about not acting too soon. It's a lot about not acting too much. And so when we look at, for example, that forecast from the Fed, they basically signaled later in the year potentially 3/4 point cuts. And this blue line, that's the green line. So they updated their forecast at the end of last year and basically, hey, yeah, we're going to cut in 2024. This blue line, anyway, is market views. This is Fed futures. It's the implied number of or level of the Fed funds rate based upon Fed futures at the end of the year. Like, what is the market through those contracts forecasting the Fed funds rate to be? And you can see when we started the year, there was all this optimism of 6 to 7 quarter point cuts. And the bottom line is we've chipped along and seen that inflation is disappointed a little bit. And then, kind of the markets parsing that Fed messaging. The punchline, not only did it come back to match the Fed's forecast of 3 cuts, it's actually now taken one off the table. So that Fed funds future forecast is basically for a couple quarter point cuts. And that's pretty dramatic. That change is pretty dramatic. And again, that's one signal of sort of a headwind that we're seeing, that people start to process this idea of higher interest rates for longer, and how does that affect spending and consumer spending? That's the kind of thing that we're watching for in terms of a headwind. Now, turning to the economy more generally, with all that said, and one of the reasons, in fact, that the Fed can hold where they are is the economy's held up. We're back to that growth line. 2/3 of the economy relates to the consumer, and we just look across the board at the consensus views as well as various experts that we track. The punchline is that the views for 2024 remain pretty darn optimistic. And we think it might be a little bit overdone, right? The idea that, well, we could see inflation not come down quite as quickly and interest rates stay higher. These headwinds kick in a little bit more. And so we're monitoring things like consumer behavior. And the punchline for us is we think the Fed will cut rates, but it won't be until later in the year. And honestly, much later in the year, 2 to 3 times. And so we're in an environment higher for longer, but as it relates to the performance of the economy and the forecast for the balance of the year, for sure, and even into next year, there's optimism there that we think might be just a little bit overdone. Now, turning to the markets and how that all influences things. So here's the yield curve chart that we look at each month of late. And the idea that top line is the current rate, basically. So that jump, right, is just showing that that basically these worries about inflation, these worries about the Fed not acting, has taken the 10-year Treasury rate up a bit. And that being the foundation for other market rates and sort of debt that we see out there is really important. And it means that cost of debt incrementally, not only is it not going down, but it's actually going up as a result of that move in the yield curve. And that, the move in the yield curve makes forward-looking bond investment super attractive, but it also has a negative price impact on bonds and how they perform. And here's an example of those forward-looking yields, right, in different categories of fixed income. So it's, as I've said for a while, it's a good time to be investing in bonds and making sure that in terms of your balance strategy, if you have a long-term allocation to fixed income and you haven't kind of rebuilt your bond portfolio, this is a really, really good time to do it. Now, turning to equities, markets have rolled over a little bit with worries and nerves about what's going on in the Middle East, for example, and worries a little bit as it relates to higher rates and inflation. But markets still remain pretty sort of richly valued by different metrics we look at, like the price earnings ratio. And yet when we sort of analyze that, as we did last month, I think, and we look at sort of the anchor, so much of that expansion of valuation is really focused on the larger companies. So for example, the Magnificent Seven, big tech-oriented companies, their price earnings ratio has really expanded. And anyway, it's related to growth, both the growth that they've experienced and the growth that they're expected to produce, where the view looking forward is the Magnificent Seven is going to have earnings growth of 24% this year compared to 7% for the rest of the market. And, so that is a real key thing. People are going to be watching the bigger tech-oriented companies to see if they roll over. Tesla, for example, has been under some pressure. They've got some layoffs. So we're looking for cracks like that. But anyway, when we look at these forward-looking growth rates, and then we adjust that price earnings for growth, so it's called the PEG ratio. And we've done this before. Basically, I kind of think of it as, whether we look at the effects of 2024 or 2025, the PEG ratios all come into a closer alignment. And certainly, given those levels of growth, it shows us that the Magnificent Seven may not be massively overvalued. But we are, again, watching for sort of a shift in things. Now, here are the numbers, basically. And again, the 2024 year-to-date numbers have sort of softened a little bit compared to what we saw last time. And yet we still see sort of dominance year-to-date in the Magnificent Seven and the related sort of FANG Plus index from New York Stock Exchange. By the way, at the bottom of the page there, that negative 2.5, that's the impact of higher interest rates on bonds, right? A little sort of negative impact on the total bond return. Now, one other thing I'll point out, which we've done before, is because of those bigger tech-oriented companies driving things higher, you can see that the cap-weighted S&P is up a bit more than the equal-weighted S&P. And that's a pattern, another thing that we're watching, because a lot of people invest in strategies that are more equal-weighted. So on average, active strategies have modestly underperformed both last year and so far this year, but again, it was the reverse of that back in 2022. So it's a pattern that comes and goes. We'll take a look at that. In fact, right here. So next up, this chart, just to explain it, just shows, and this is important to understand how the markets come and go. The spirit of it is to say, look, when we see just think of it as the two colors, and I'm a little colorblind, but the bright green basically is when the cap-weighted index is outperforming. So there are periods of time when the cap-weighted index outperforms, and then there are periods of time when the equal-weighted index outperforms. And what you want to be careful is to not be switching back and forth as you look back at strong performance, right? The whole idea is if you say, hey, I'm going to look back over a period, see who the strong performer is, and then invest in that, it's not uncommon to do that and rotate right into a strategy that's about to come out of favor. So this just reminds us to almost like to stay the course and have patience with these performance patterns in the near term because, the bottom line is they come and go. And so, again, for this month, an interesting chart to check out. So as we look forward, just recall that we're basically kind of monitoring the macro environment. We're keeping a close eye and doing a lot of work actually on artificial intelligence, the influence of it, how that can influence our investing. But then at the same time, those headwinds that we've talked about, the higher interest rate environment, looking for patterns of change, let's say with the consumer, and also things like, kind of the performance of those magnificent 7 companies. And then, of course, the unfortunate situation in the Middle East. And so we'll keep a close eye on that, keep doing our work, keep publishing things like this. One thing I want to leave you with is, we're setting up for the election. So just a few slides on that election here in 2024. The first is to say, remind ourselves that as it relates to sort of the confidence out there in the world, interestingly, generally speaking, those individuals whose party is in power, in this case it's a presidential administration, tends to feel a little bit better about the current environment. This chart just captures the idea that Democrats feel a little better than Republicans, but when we go back to the Trump period, for example, it's sort of the opposite of that, and on and on. You can kind of work your way back in time and see how those things come and go. But we're setting up for a real balance of power sort of contest, right? That basically, when it all comes down to it, it seems like the elections are a bit of a flip of the coin. So we'll see where voters end up guiding the government to go. And it's, still, while we're sort of in the general election phase, we know who the candidates are for president. The bottom line is there's a lot of news cycles, as they say, between now and election day. So we'll see where things land. Now, this is part of a bigger global sort of election cycle. And, just to take a step back on that, again, we see themes playing out across the world when we evaluate these various elections where, candidates are focused on local economic opportunity. They relate to that protectionism, taking care of their constituents, and that all influences international relations like trade. And so we have had things like Taiwan in focus, which tends to have landed in a more Western-centric government. We have Indonesia in focus, not only for today, think of supplying nickel for electric vehicles, but out into the future, it's a country that is forecast, you can see on the right, to become a more significant global economic player. And the same with India. India is growing and is going to become an increasingly important sort of trade partner. Right now, very much aligned with the West, but it's us and China kind of competing for all this attention. So again, those things are in focus. Those are the themes that we're seeing, and it does come back here to the U.S. and some of the themes we see with this election. So listen, thanks so much for watching this episode. I'll invite you, as I always do, to check out stifelinsights.com, where all our work is housed. And until next month, check it out, and we'll talk soon. Thank you.